This is Brooks, and this is my price action trading course. This module is about trading strong bear channels. Remember the market cycle. The market is either in a trend or in a trading range. If it's in a trend, it's either in the initial phases, the breakout phase, the spike phase, or it's transitioned into a channel where there are some pullbacks. The channel evolves into a trading range. The trading range then breaks out in either direction, and then the process begins over. In a bear trend, the bear begins with a spike. Sometimes it's a single unremarkable bear trend bar. Sometimes it's a series of bear trend bars. The spike, breakout, same words for the same thing. Strong bear trend, again, all three are synonymous. The bears control the market, and the market's very one-sided. When the market transitions into the channel phase, it's a weak bear trend. Sometimes it's still very strong, but it's weak compared to the breakout phase. There's some two-sided trading and occasional pullbacks. The bulls are occasionally in control, and when they are, that creates an occasional bull bar or pullback. How do you know that the market is in a channel? Whenever the market can be contained within two lines, it's in a channel. So whenever there's any two-sided trading present, there's a channel. It doesn't matter if you can see how to draw the lines, the market is in a channel. Types of channels. A channel is part of a trend. It's the weaker part of a trend after the breakout phase. It's sloped up in a bull, down in a bear. And in a trading range, it's horizontal. In triangles and wedges, they're also channels. When the three-push pattern, the triangle is horizontal, it's a triangle. When the triangle is sloped up or down, it's a wedge. Bear channels can be strong or weak. A strong channel, minimum two-sided trading. It behaves much more like a spike, and you should only trade in the direction of the trend. You should only short when you have a strong bear channel, a very tight bear channel. When the channel is weaker and it has big swings up and down, but it's still forming lower highs and lower lows, two-sided trading is prominent. It's very similar to a trading range that has a slight slope to it, and you should trade it like a trading range. Buy low, sell high, and scalp. When you're having a hard time deciding whether the channel is weak or strong, assume that it is strong and only trade in the direction of the channel. A bear channel, only look to sell. If you can't decide whether or not the market's still in the spike phase or if it's in a strong bear channel, assume it's a breakout, a spike, and only look to sell. When a channel looks like this, very tight, the lines are close together, the pullbacks don't go very high up, impossible to make a profit buying, you should only look to sell. So only when you get pullbacks up near the top of the channel, you look to sell. This is very one-sided, not much bull strength. On the other hand, when you look at this on the right, this is the daily euro versus the dollar, Forex. It's forming lower highs and lower lows, so it's a bear trend, and the swings are broad, so it's a channel, but it's almost like a trading range that has a slight slope to it. You should trade it like a trading range and buy low, sell high, and scalp. When a bear channel is very tight with very small pullbacks, it's basically like a breakout, and in fact it is a spike, a breakout on a higher time frame chart, and it can be almost as strong as a breakout. When that's the case, trade it like a breakout and only look to short. So when a channel is very tight like this, the pullbacks are very small, I don't care that there's a strong bull reversal bar here. The channel is very tight, only look to sell. Here we had a small spike, a 2-bar, 3-bar spike, a pullback, and then a very tight channel. But the channel is so tight, it's very one-sided. On a higher time frame chart, I'm sure it's a breakout. Like on a 15-minute chart, it's probably a series of bear bars. You got to look to sell for any reason and treat it like a breakout phase of a strong bear trend. Channels sometimes can be almost as strong as spikes. Again, when the channels are very tight, the pullbacks are very small, the lines are close together. There might be some two-sided trading, like an occasional bull bar or an occasional doji, but it's very little. For the most part, it's one-sided. The bears are in control. It's still weak compared to a breakout, but it's so strong that you should treat it like a breakout and only look to sell. The stronger the bear channel is, the better it is to swing than to scalp. And like all channels, a strong bear channel follows a spike. And if the channel is very strong, very tight, it is a spike on a higher time frame chart. So it's a strong trend on a higher time frame chart. Only look to sell. So what are some of the signs of a bear breakout, a spike? You want to see one or more big bear trend bars, big bodies, preferably consecutive big bear bars, closing on their lows, very small tails below or no tails below, no sign of buying pressure, and you want the context to be supportive of lower prices. For example, you don't want this to be 2 or 3 consecutive bear bars inside of a trading range, because it could simply be a sell vacuum test of the bottom of the trading range, in which case a reversal is more likely than a breakout. Signs that the market's in a bear channel: you have pullbacks, you have some bull bars, you have overlap between adjacent bars, the market sometimes goes sideways, and you sometimes have bars with tails on the bottom, showing that they bought the bar into the close of the bar. Also, instead of very big bear bars, you tend to have smaller bars, small bull bars and small bear bars. When the channel is very strong, try to swing at least part of the position. When you are scalping, you use a very tight stop. However, you still want the reward at least as big as your risk. Advanced traders, they can scale in. So if the market's going down in a very tight channel, advanced traders will scale in on pullbacks when the market's going against them. They'll also scale in as the market goes with them. They'll sell this close, they'll sell that close, they'll sell that close. It's good if you can diagnose the situation early. We have a trading range. It's still a trading range over here, but we're forming lower highs all the way down, and now we're starting to get lower lows. We have a low here, and over here we have a lower low. We have a bear breakout, so we have to think about the possibility that the market may enter a channel phase. We have another bear breakout, so again we might be entering a channel phase, and the market is failing at the moving average. It was below the moving average for about 10 bars, tried to break strongly above it, immediately had a bear reversal. Tried to get above the moving average here, big tail, reversal. Tried to get above it here, tail. Tried to get above it here, tail. So the market is probably in a bear trend. It does not look like a strong trend because we have pullbacks along the way. So if it's not a strong trend, it's a weak trend. If it's a weak trend, it's a channel. Start looking for ways to draw channel lines. Every time you see a new swing low, you connect it with a prior swing low. Every time you see a swing high, connect it with a prior swing high. All right, so how do you sell? How do you get short? Where's your protective stop? Okay, is it time to sell? If ever you feel agitated and you're desperately hoping for a pullback that will allow you to sell using a smaller stop, then don't wait for the pullback. Sell. That tells you that you know that the trend is very strong and you must sell now. Sell at least a small position at the market. Figure out how far your stop is. You look at it and say, wow, that's a lot further away than I want to risk. Well, it's not. You just trade very small, and that is your stop, no matter how far away it is. So you determine where the protective stop belongs. From there, you figure out what size position you should be trading. If your stop is 3 times bigger than average, trade 1/3 as big as average. And then sell right now at this minute, at the close of the bar, as the bar is forming. It doesn't matter. You got to get short at least a partial position and rely on your stop. So how do you short in a tight bear channel, a strong bear channel? The same as you do in any strong bear trend. You sell at the market. You sell at the close of strong bull bars because they are attempts to reverse the bear trend, and 80% of reversal attempts will fail. You sell on the close of every strong bear bar because that's an attempt to resume the trend, and it probably will succeed. You sell below bars, below the prior bar, because you're betting that the trend is resuming. You sell above bars because, again, it's an attempt to reverse the trend, and it probably will fail. You press your bets, and you sell breakouts below prior lows. Anytime you get a small pullback, you sell that as it's beginning to resume back in the direction of the trend. So you're selling breakouts of bear flags. You sell at resistance. If the market comes up to the moving average or a trend line, you sell. If it comes back to a prior spike bottom, you sell. And you take profits at new lows and at support. So how do you sell? Initially, if you're convinced the market's going lower, you just sell something at the market. Determine how far your protective stop has to be, and then adjust your position size so that you're still trading within your comfort zone and you're not risking too many dollars. So for example here, you got a bear breakout, a close below the low of the prior bar. Just sell at the market. And you can say, well, where do I put my stop? Well, worst case is you put it above the most recent lower high. We're starting to form lower highs, so we're trending down. You could also put it simply above the high of this bear breakout bar. You can sell at the close of any strong bull bar, betting that the reversal attempt will fail. You can sell at the close of any strong bear trend bar, betting that it's a resumption of the trend and it will succeed. You can sell below bars and above the prior bar. So for example, strong bear bar, sell the close. Bear bar, sell the close. A strong bull bar, sell the close, and put a stop above the most recent lower high, betting that the market will continue to channel down and form a series of lower highs. Sell below the low of the prior bar. So when this bar forms, put a stop to sell below it. Doesn't get filled on this bar, put the stop below this bar. Doesn't get filled, put a sell stop one tick below the low of this bar. You finally get filled. You sell above the high of the prior bar, betting that any reversal attempt will fail. Here is your stop at this point, maybe above here. So you trade small enough so that the total dollars that you're risking is no bigger than when you normally are trading. You can press your bets and sell breakouts below prior swing lows. You can sell small pullbacks. You can sell breakouts from bear flags. The market is falling below a prior low, sell. Here's a prior low, here's a prior low, market broke below. You sell on a stop, one tick below here, one tick below there. We have a prior low, an attempt to reverse. You place a sell stop one tick below this bar or one tick below this bar. You sell pullbacks. You can have a fixed number of pullbacks, fixed number of points. Like you might sell 5 ticks or 10 ticks or 15 ticks above the most recent low. You can sell breakouts of bear flags here and here, here. You keep redrawing the channel lines every time the market makes new lows and new highs, and the channels tend to get flatter and broader, okay, as the two-sided trading increases, and eventually the market evolves into a trading range. And once it does, then you trade it like a trading range. Other ways to sell: you can sell at resistance, and you can take profits at new lows and at support. Isn't it better to wait? It always feels like the market's forcing you to sell too low, and that a big reversal or a big pullback can come at any time. It doesn't matter. You live in uncertainty when you trade. You're never going to be certain, and you just rely on your systems. You decide where you are in the market cycle, and then use the trading approach that's appropriate for where you are in the market cycle. Again, the setups never look very good. However, you know it's a bear trend, and therefore you believe there's a 60% chance of lower prices. It never feels like 60%, but if you believe the market is going down, assume that the probability is 60%. You'll never be more than 60% certain, because traders always live between 60% and 40%, and never be paralyzed by the 40% chance of a loss. That's part of doing business. 60%, it doesn't get better than that as a trader. And if you're a trader, trade, take the short. So you sell at resistance, top of the channel, near the top of the channel, look to sell, either at the channel or as the market reverses down. Near the moving average, either sell near the moving average or sell as the market reverses down. And again here. As the market becomes more two-sided, you use new lows to take profits. Market falls below this bar, let's say you short it up here or you short it here, you take profits either at a limit order at the prior low or as the market reverses up. Where are your protective stops? As long as the market continues to form lower highs, it's still in a bear trend. And if you're swinging, you're believing the market's in a bear trend. So if it goes above the most recent lower high, your premise is wrong. So you should put your stops, trail your stops above the most recent lower high. Every time the market makes a new low, lower your stop to the most recent, one tick above the most recent lower high. When you're scalping in a strong bear channel, you don't want to allow pullbacks, and you get out immediately above any bull bar or even any strong bear bar. So let's say you shorted either here or here, okay? If you begin selling this close, for example, your initial stop is above the most recent lower high, which is up here. This bar is such a big, strong bear trend bar, you possibly could put your stop just above it, but this is just a little bit higher. I probably would choose above the most recent lower high. So you short, let's say you short that close, so you get filled right here. You could put your stop way up here. That would increase the chances that you'll have a profitable trade, but because you're risking more, you'd have to trade much smaller. Most traders would just short here and either put their stop here or here. Okay, the market breaks below a prior low, then move your stop down to above the most recent lower high. Every time the market goes to a new low, you raise your stop to the most recent lower high. At some point you have to take profits, so you look for reasons to exit after your reward is at least twice the size of your risk. You can place a limit order at twice the size of your risk and exit with your limit order, or you can trade from any reversal up from a bear breakout of the channel. So if you have a bear channel and it breaks to the downside and it starts to reverse up, you can exit. You can also take profits at measured move projections or other types of support. So for example, the market's trying to form a little trading range here. Always come up with measured move projections because they're potentially areas of support. Here we have a measuring gap. This high stayed below these lows, so it's possible that this pink line is a measuring gap and the middle of a move. Here's the start of the move, here's the possible measuring gap, here's the projection for the measured move down. So that's a logical place to take profits. You draw trend channel lines below the lows. That's down here. So we're starting to get an accumulation of support in this general price area, so it's probably going to lead to profit taking. We have a trend channel line here, and then a big bear breakout, the biggest bear bar of the past 20 or 30 bars. So it could be an exhaustive sell climax, and it could be an exhaustion gap. The close is below the low of the prior bar, so it's a gap. Then we have a strong reversal up, and it closes that gap. So this is probably a sell climax, an exhaustive sell climax, and the market will probably have 10 bars and 2 legs at a minimum sideways to up. So you might exit above the high of this bar, you might exit above the high of this bar. The market might be always in long here, so you could exit there as well. And that is the end of my module on trading strong bear channels.